Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for November 10th, 2012. We have a market that is in sideways volatile conditions. It's neutral on an annual basis, looking at weekly RSI 14. On a 10-day basis, it's oversold at 10 on the 10-day NDX. The long-term trend at compared to the 200-day moving average is at 0.64%. So we're resting right on the 200-day moving average in red sideways condition. The slope of the 50-day moving average has gone to yellow neutral at negative 0.08%. A negative slope to the 50-day moving average is not a good sign. ADX 14 at 17.8 is neutral, no trend. However, the minus DI is greater than the plus DI, so the trend that is developing is pointing towards the downside. ATR percentage has increased to a volatile 1.43%. Blended monthly rebalancing, the current holdings are remain the same with the European 350, financials, and China in the 13 ETF portfolio. It's the Euro-Asia blend, Asia less Japan, and emerging markets. Next reevaluation on or about 1 December. Inside ETF2, the theoretical model exposure is at 40%. The model portfolio itself is at 60% exposed, with two positions that were had their stops hit this week. It's just a quick look at the model portfolios. Again, you can see more than half are on cash in both models. The market health check. The vertical blue lines represent 10, 20, and 30 days of look back. The horizontal red line represents a support level that is held previously. We're down to 1. That's right just above the 200-day moving average. It's broken through these previous support levels as a consequence of the Obama election and the interpretation of the market that that's a bad thing. The horizontal purple lines are previous resistance levels that remain price targets for us on any rebound. The central black line is the 30-period regression line, which is the best fit line for the last 30 trading days. The black lines on the outside are the channel formed by the maximum excursion from the regression line during the look-back period. The blue river is the 30-period Bollinger Band plus or minus 1 standard deviation. That represents the long-term trend, which has rolled over, and now you'll notice that the width of the river is getting wider, and that's a sign of increasing volatility. We went through the 5% stop at around 139-ish, which is a 5% sell-off from the swing high previously, which is around 148. Between 0 and 5% pullbacks we'd classify as noise, and we're now into the correction phase, which has taken us out of the bull and into sideways volatile. So that's not looking good. Support right now at 137.5 at the 200-period moving average. The last time it did that was back in June or July, and there was about a 10 to 12% move off of that, which is what took us up to this 148. So that's the magnitude of the move that still could be looking at us on the upside. Price targets at 139, 141, 144, and then it has to really get above 147.5 to be significant for a resumption of the bull. But it doesn't look good right now. Oversold on a 10-day basis. The jaws of percent price oscillator pointing down. That's been a reliable indicator here since about the end of October, when it warned about downside moves. So right now, I think we're still working off the election interpretation yet. So we'll see. ETF 2, the regional report, the top 10 ETFs, 6 out of 10 are in a cash position, all the U.S., plus Latin America and Japan, and that leads us to a 40-60 split between invested and cash. The EFA is stronger than SPY right now, so it's the globals are in better shape than the U.S. And inside the U.S., it is mid caps, small caps, large caps, then tech. Two strongest are Latin America and Asia less Japan. The two weakest are Latin America and Japan. That market condition should read sideways volatile. We'll get that fixed next week. Looking at the world market model, most of the U.S. below average. Get strength in Asia with Australia, Hong Kong, and India. And anything Europe is looking good. Emerging markets are above average, but Latin America lagging. Canada and Mexico above average, but Brazil lagging. Gold and silver doing well among the alternative asset classes. Anything Europe is looking good. Financials are strong. The defensive plays are strong in healthcare, but weak in utilities and staples, and that's an oddity right there. I would expect if we see more weakness in the U.S. that those defensive plays are likely to come online. So I'd be looking at healthcare as a way to as the strongest defensive play in the stack right now. Top 30 ETFs from the ETF2 database. It's still home construction remains remarkably strong. You can see silver, emerging markets bonds have moved back up to the top of the stack. And you'll see the U.S. has dropped out of this, and now we get some financial preferred, Switzerland, high-yield corporates, Germany. And then here's the healthcare sector, Spider XLV. That one to me looks like a reasonable position to own if you have to have U.S. large cap exposure. The Dow 30 looking at this through the same lens, but sorted by the strength column. Bank of America, Home Depot, J.P. Morgan, Travelers, so it's the financial sector leading the way. Hewlett Packard, Intel, DuPont, Coke, and Alcoa. Hard to see how the U.S. economy is going to do any good with those guys suffering. But still some opportunities down there for value players. The ETF liquidity report, just again for your reference, see the increase in volatility is reflected in VIX with a 5% intraday ATR percentage. Excuse me. We're going to shift now to the daily report. Let's see what we can come up with here. A large number of signals on overreaction and channeling. We're so close to the 200-day moving average, you wouldn't be wrong to play that conservatively and waiting to see. You can see the volatility has spiked up now after the election into the volatile range, and ADX is actually starting to strengthen again, but with bears in charge, that's not a good thing. Lots of channeling and overreaction signals here. 551W is in coal, Johnson & Johnson, Bank of America. In the auto framer, you have some usual suspects in Cliffs Natural Resources, Pfizer, U.S. Tech Spider, U.S. Small Caps, Energy, Spiders, Diamonds, and the financial sector again as well. You can see Friday's sell-off, just how many symbols made new 10-day, 1 month, and 3 month lows. Everything that's in the negative is a breakdown to a close at a new low. Lots of RSI2 candidates to look from. Only a couple auto framers, though, set up with Walmart and Pfizer. Inside the ETFs, only one doji, that's in DBA, the agriculture index. Lots of channeling overreaction. A washout pattern in oil, 551W here in coal, and then a lot more auto framing targets to look at, and half a dozen RSI2 candidates as well. Looking at the market mosaic indicators, the regression line showing the weakness here. It's now more than one standard deviation below the 6 month average and continuing to decline. The crossover of the regression line at its 10-period moving average was a reliable early warning for this decay in the signal strength that we've seen. So that's why I pay attention to it. It gave us a warning back when about 6 to 7% ago that the truth was changing. And now you can see in the percent stretch compared to the 200, we're back to the 200-day moving average within a couple pennies of it. And so that's been an adverse 3 standard deviation move in the last 3 months. The 10-period slope z-score is rolled over and left the reservation. Now the 30-period is leaving the 1 standard deviation band. 90 has pulled back into normal. That tells me that there's still another leg down potential here, and that would now start to take a close look. We're seeing the same pattern as we did the last time it touched the 200-day moving average, but there's another leg down. This has only had 2 down, so we could get another 5 to 6% sell-off here in the short term. The rebound last time, however, once it crossed back into the river, signaled a grinding bull up. Is that possible? Sure. But the downside is the easier trade to make right now. You can see SPY has left the river. Treasuries are starting to hook back up. Gold may have put in a little swing bottom. This almost looks like a triple screen, little cup and handle. That could take off. Technicians will be all over that. The small caps are slightly better than the largest, but still nothing to write home about inside the U.S. markets. Just including standard reference charts for you. I like this the signal to noise ratio here in treasuries, gold miners, and technology. They've been very directional. That would give us reason to want to trade that. More reference data. And that's where we'll leave it for tonight. Keep your powder dry. It's the short-term opportunities while the market continues to digest the meaning of an Obama re-election. I still think the easier money is elsewhere. I'm in no hurry to create a grand narrative for this. Just the intraday volatility has been very, very helpful for us. So that's the way I'm going to continue to trade it. I think we had a couple double-digit R days last week that are well worth your attention to get in the chat room and take a look at those, and you can trade along with us. This is Ken Long from Tortoise Capital. Take good care, and we'll see you in the chat room.